Hello, this is Mike Foreman with Game Plan Retirement, here for another episode of Let's Ask Mike. Thanks for tuning in. Today, a lot of good questions have been coming in recently, and just recently, today, actually, one came in about fixed annuities and really what those are all about. And so I thought I'd, in addition to answering the question directly with my client, I thought I'd also share a little information here. So a fixed annuity is a type of an annuity. It is issued by an insurance company, but as opposed to a variable annuity, which is invested in mutual funds and the market, it basically just has an interest rate, a lot like a CD, but it is not a CD. CDs are issued by banks and carry FDIC insurance, whereas annuities are issued by insurance companies. There are insurance commissioners in every state that make sure that insurance companies, their finances are up to certain standards. And there are also rating agencies that analyze how much in reserve insurance companies have on hand and then have a rating, based on that for safety. But basically, a fixed annuity pays an interest rate for a given amount of time. You choose when you buy it, how long you want the interest rate to be guaranteed for. Often they have surrender charges, so you want to make sure you hold them till their maturity. And the interest that is earned on annuities is not taxable while it's being earned. So it's tax deferred. At the end of the maturity, you can either roll it to a new annuity and avoid the taxes on the interest at that time, or you can cash it out, at which time the interest would be taxable. Or there's also some provisions called annuitization, where you can receive a guarantee of payments throughout your life, and there are tax benefits where a portion of each payment is the return of your principal, and and part of it is the return of the interest, which would be taxable again. And what I'm describing there is a non-qualified annuity. These could also be owned by IRAs, in which case all income coming out would be taxable. The other thing I wanted to kind of revisit a little bit, because this, as part of this question, has come up a lot lately, is this is a normal yield curve. And this would be true, basically you plot any type of security, a fixed income type of security that you're looking at based on its maturity. And in a normal environment, you'll receive higher interest the longer term you're willing to hold, or the maturity level rate, the maturity of that particular security. So short-term bond or investment should have a lower rate of return than a longer term. And often when interest rates change, or the Federal Reserve changes rates, really what they're changing is the interbank loan rate, which is what banks charge each other to hold their assets, their deposits in another bank overnight. So super, super short term. And so sometimes when interest rates are going up and the Fed is increasing that short-term rate, you'll end up with an inverted yield curve. And sometimes you can end up with an inverted yield curve for quite a while. And that's where short-term rates are higher than longer-term rates. There's various ways to interpret that. A lot has to do with what the future might hold, which is hard to determine. And some folks think this is an indicator that a recession is coming if you have 2 quarters with an inverted yield curve. But actually that's not 100% true. There is a group of economists that determine whether or not we're in a recession. They use many, many other tools in addition to that. So you can have an inverted yield curve for a while and not end up in a recession. So again, I just wanted to talk a little bit today about fixed annuities. If you want to talk about them further, please give me a call or send me an email, and hope you find that helpful. And thank you for tuning in to Let's Ask Mike. I appreciate it. Bye-bye.